But I thought we would start, just have you give us a little bit of baseline fundamentals on the Federal Reserve System, its dual mandate of low interest rates and low unemployment, and just talk a little bit about the differences between monetary and fiscal policy so we've got a good baseline.
Okay, baseline, the Fed system, I mean, we could take a detour, and we won't, into why are there 12 regional Fed reserve banks and 7 governors that are political appointees to 14-year terms, and summarize it to say, because when they set up the Federal Reserve Act, just like today, they did not want Washington, D.C. plus Wall Street to be controlling the entire U.S. financial system with no input from the rest of the country. So they put in automatic Fed independence, regional independence, and they set up 14-year terms that are staggered because they wanted to make it as independent from political interference as it was possible to make. Monetary policy means the setting of interest rates. And we go there every 6 weeks and we vote on the interest rate, and we set a short-term interest rate, which we think influences financial conditions and influences credit conditions more broadly. Everything else is fiscal policy. Every other policy thing, taxes, tariffs, all of the whatever Washington's going to do, regulatory and et cetera, that's the realm of Congress. All we do is set the interest rates, and we have what you described, the dual mandate. The Federal Reserve Act says we are to set monetary policy to maximize employment and stabilize prices. That's the whole job. That's not easy to do sometimes, but it's simple to understand, and our close to only tool is we can tighten rates, we can loosen rates. It's sort of like a screwdriver. And if your problems are, hey, the fender is loose, then tightening it is the right answer. If your problems are, we don't have breakfast ready, the screwdriver, it doesn't help you to make breakfast. And so we try to stay out of the fiscal policy business, other than that's a condition that we have to deal with. But we try to stay out. In a game of mutual respect, they don't interfere with the setting of monetary policy, and we try not to interfere with telling Congress what it's supposed to do, or the president what they are supposed to do.
All right, so let's get into it a little bit here. Let's talk about the 800-pound gorilla, tariffs. When have tariffs been used effectively, if ever? And help us understand how countries treat U.S. companies with regards to tariffs in various ways to help their domestic companies better compete with U.S. companies and their products. And then I will give you a quote to start with. General Motors CEO Mary Barra said, "For decades now, it has not been a level playing field for us automakers globally with either tariffs or non-tariff trade barriers. So I think tariffs is one tool that the administration can use to level the playing field."
We've been here 6 minutes. He's already trying to get me in trouble. I just told you. Look, if Congress and the president want to pass tariffs, they can pass tariffs. I've been in the Fed for 2.5 years. Before that, I was a research economist for 30 years at University of Chicago. Nobody's going to out free trade me. The economists don't like tariffs, but that's not relevant to the setting of monetary policy. What's relevant to us is, what are they going to decide to do? Anything that affects prices, the law says we have to think about it. So we are thinking about it. The complication is things that overheat the economy and generate inflation can be lasting. And in theory, Econ 101 style, a tariff is supposed to be a one-time increase in the price level, not a lasting impact on inflation. The growth rate, it doesn't affect the growth rate. If you put in a 10% tariff, you'd have 10% inflation for 1 year, and then there would be no more inflation from it. in theory, it's transitory. But I say that with that inflection because transitory is a bad word. We just went through a period where, on the same grounds, the Fed, I wasn't there, but the Fed argued these are supply shocks coming from COVID. That should be transitory. And it turned out it wasn't that transitory. The inflation lasted for 2 years plus, and we still are dealing with some of those issues. So personally, I'm a little wary just jumping to the Econ 101 conclusion that the tariffs will be transitory, have a transitory impact on inflation. But that's where we are. That's where we got to think about it. And it's not an easy situation for the Fed to be in because it's a stagflationary direction. I'm not saying it's stagflation, but as a direction, it makes both sides of the mandate get worse at the same time. Employment goes down, prices go up from tariffs, and there's not an automatic playbook of what does the central bank do if both sides get worse at the same time.
So let's talk a little bit about economic theory for just a minute. So what does a free market economy mean to you? Will we ever get there, or is this just a theoretical exercise? Or in your view, should we ever get there?
These are some deep questions. Look, the free market, let's call it market-driven solutions, I think, whether you think in theory or you just go look around the world at the experience, the free market is by far the most powerful mechanism to deliver what the economists call consumer surplus and producer surplus. And the more centrally planned things are, the more mistakes happen. Because the market mechanisms are very powerful. Will we ever get there? I don't know. You know, that's not. You've jumped us out of the dual mandate lane. If we have stable, full employment and price stability of 2% inflation, I think in the private sector, people can count on, we want to, in a way, be like the referees in the basketball game, that if nobody ever said anything about the referee, then the referee probably did a good job. And the more the game becomes about the referee, the worse it is. And here, if you can set inflation to be low, steady, so that it's not factoring into business decisions, that's where you want inflation to be. That's not where it was, as everyone knows, in 21 and 22, even in 23. Prices raging out of control, the cost of living interpreted by business and individuals as a crisis of affordability. That's the Fed's got to step up and fix that. And I think that's a key part to free market, the market mechanism. You got to have price stability to be able to maximize employment.
Okay, one more theory question before we dive into some other ones. So is it an interesting time in the study of economics, especially in the wake of the pandemic? And I'm thinking specifically about the inverted yield curve. I'm thinking about industries like the trucking industry. I know Mike Gannon's going to talk about it in a little bit. You know, the trucking industry has been struggling mightily for 3 years, but no recession has resulted, which typically happens.
Right.
And then add a layer of cryptocurrency that's relatively new. So is this an interesting time? Are you fascinated by it? Are you troubled by it?
Interesting in the worst possible way, and the best way. Yes, yes, to all of those. Okay, now is this a weird, interesting time? And then there's some specific indicators you cited. The yield curve inverted just means long rates, 10, 20, 30-year interest rates are actually lower per year than the 1-year interest rate. That's unusual. And usually when that happens, that's a pretty solid sign that a recession is about to take place. we had the yield curve inverted for 2.5 years with no recession. And people looking around saying, wait, what? How could that be? Trucking, close to my heart. My dad was in the truck trailer manufacturing business for his whole career. I got a bunch of uncles and cousins that were in truck driving. And my one uncle ran a trucking company for a long time. It was always a leading indicator of the business cycle. Hasn't been. It was, if you took that, or temporary employment, temp firms, another indicator of the business cycle. They've had month after month after month of losing jobs in the temp industry. Normal sign of recession that didn't happen. One of the things that made this such a weird, interesting, maybe I should call it time, is the COVID business cycle looked nothing like the business cycle. I told you the Fed has one tool, which is about raise the interest rate or lower the interest rate to affect the interest rate sensitive parts of the economy. And those are normally the most cyclical parts of the economy. Durable goods, housing, business investment, the kinds of things that pay attention to the interest rate most closely are also the industries that go up with the business cycle, down with the business cycle. The COVID recession looks nothing like that. It's not a recession. Demand for durable goods went up in the recession because you couldn't spend money on services. The recession was led by a bunch of things that never go down in recession, like elective surgeries and going to the dentist and a bunch of service sector things. So as we've come out of it, as I say, if you have seen anybody professing to be an expert, no, I know what's going to happen, they're lying, because nothing like this has ever happened before. So we had to think it through. We had to kind of think through the fundamental economics. They've meant many of these recession indicators just didn't work. I think because this business cycle, recession and recovery, really looked nothing like the demand-driven recessions of the past.
So last month, the Consumer Price Index measure of inflation was released at an increase of 2.3%. What should people and businesses make of this data?
That number is 2.3% looking backward. Okay, so it's the last 12 months, what has been the inflation rate. And of course, what matters is what will the inflation rate be that's coming in. So this was the last, we've had a couple of months of quite solid reports that look good. Inflation looked good. It's good. It's coming. The Fed's 2% target is not CPI inflation. It's PCE inflation. If you get into the weeds, the CPI has a basket that they announce, here are the goods, and they track the prices of what's in the basket. The PCE inflation tracks everything, all personal consumption expenditure. So it's a little more comprehensive. It's a better measure. I think the 12 months of PCE inflation were around 2.1%. So very close to the target. But that's old news. That's over the last year. And so these were the last reports coming in before the tariffs. So now they're just question marks. Is that are the tariffs going to have a small impact, or are the tariffs going to have a large impact? And now we're just kind of, we gotta wait and see what happens.
So we talked about the Consumer Price Index. So what are the other data sets that you look at most closely and most impact your thinking on the current state of the economy? And again, a little bit into how is the fiscal and tariff policy uncertainty affecting the economic data that the Fed uses to make decisions?
Okay, there's two different parts of that. Let's start with the second part. How are the tariffs affected? Well, look, they probably will directly affect the prices. When we're meeting with business leaders, A bunch are talking about how quickly would cost increases be passed through, and they think pretty quickly. Last night, I had dinner with some CEOs and business folks here in Cedar Rapids, and they described that in some cases they just added a column to the spreadsheet, which is the tariff price. They're just going to add it on. So that implies a 100% pass through of whatever the tariff cost is going to go right into the price. So that one we would see within a month, certainly within a couple of months. If it's going to affect prices in a significant way, you would expect there's a 1 month lag on the price data. So that one would start showing up. The other expression that we get of concern from folks that we're talking to, and it's worth remembering, the Chicago Fed district is most of the economies of Iowa, Wisconsin, Illinois, Michigan, Indiana. So it's kind of heart of the Midwest. And make no doubt about it, that's by far the highest exposure to tariffs of all the districts in the United States. Of the 7 most exposed states, 4 of them are in that district. And Iowa, I think, is number 4. Michigan is number 1, Indiana's number 2, maybe Kentucky's number 3, and I think Iowa's number 4, because a lot of manufacturing, a lot of agriculture. Both of those get imported inputs in the supply chain and rely on export markets for a lot of their output. The expression that the folks in the industry have to us is, what if this leads to slowdown? What if this raises our costs and leads to slowdown? That one won't show up in the data for a while. So that's why we do almost 40 roundtables a year throughout the district, trying to talk to business leaders, like what we did last night, like what we're going to have on the panel here today, because that's in real time. That won't show. The GDP numbers don't come out for a quarter, so it will be a long while before we find that. And I apologize for being too long on this one. What do I look at? You saw the dual mandate. Mostly we look at job market numbers and inflation numbers. Those are the 2 most important numbers. But when I joined the Fed, it was not as a dove or as a hawk. I joined a proud member of the Data Dogs caucus. And the first rule of the Data Dogs is know when is the time for sniffing. And the time for sniffing is whenever you have uncertainty, gather more data. And like with the other dogs, anything that hits the floor, come over and sniff it, because it might be food. And so I don't throw any data away. We've seen since COVID, some of the private sector data sets have been extremely useful for supplementing the official data. There's still, the US is the finest official data. I would say it's a gold standard, but in my world, that's a bad thing. We don't want the gold standard. We have the best data. A lot of these private sector, especially housing market data, pricing data, and some orders data, I look at a lot. The credit card information they release, that's really good information on consumer spending.
So I think I saved it to my 6th or 7th question about interest rates. So, what should businesses expect regarding interest rate policy yet this year?
Again, I can only speak for myself. I think that partly the answer to that question depends heavily on, well, what's going to happen in the next 3 months to the data on prices and to the data on employment. There's a lot of policy uncertainty. We had a Fed Listens event and a big advisory council event. And one of the folks at that described this as, he was a leader of a construction firm, described this as a pencils down moment, that they just cannot proceed to the next section of the test until we get a little more clarity, a little more consistency. If what happens is the impact of the policy after all of this dust clears out of the air is like where we were in February, March. I already told you, I think where we were coming into April 2nd was stable, full employment with it prices coming down to the 2% target, and therefore rates would be a fair bit below where they are today. But with the uncertainty, I can't express that with too much confidence because who knows, if we wake up tomorrow and the tariffs are going back to 50% on the world, there are a lot of domestic production that's going to suffer and have to figure out how to deal with that.
So you talked a little bit about your district's manufacturing base.
Our district.
Our
yes.
district. What factors are currently affecting the manufacturing industry? How are supply chains evolving post-pandemic? And how has your own thinking on supply chains evolved?
My thinking on supply chains evolved. Most economists never thought about supply chains before COVID. They just kind of assumed, oh yeah, the costs go up and that's passed through, costs go down and that's passed through. We discovered circa 2020 that a bunch of the things that we took for granted, you can't take for granted in a moment of crisis. They take a lot longer to play out. My read of the data and in discussing with people is that the supply chain is mostly healed. It's mostly back to normal. That led into the anxiety as the tariffs began. Oh no, don't take us back to a period that we don't ever want to go back to, a period like 21, 22 where costs are raging out of control, or a period like 2020 where there are literally just shortages and we can't make the product because we can't get chips and we can't get workers and we can't get those. So I think the supply chain is mostly back. I think the healing of the supply chain is what allowed 2023 to be a most unusual, in the positive way, year for central banks, which is to say, if you plugged into ChatGPT at the beginning of 2023, what must the central bank do? What should the Fed do? Inflation is way too high. It would have, based on the historical experience, said, jack the interest rate up to 15% and have a very serious recession. That is the only way anyone has ever gotten rid of inflation. And yet in 2023, inflation fell pretty close to as much as it has ever fallen in a single year. And not only was there no recession, and not only did the interest rate not go to 15%, the unemployment rate never got above 4 for the entire year. Nothing like that has ever happened. And I think one of the key ways that it didn't happen, there was too many negatives in that one, but one of the ways that, but the way it happened was the supply chain was healing, and so it got what some people derisively called immaculate disinflation. It turned out to be true. We did get some immaculate disinflation because of the healing of supply.
So let's talk about the labor market. Are we seeing signs of a slowdown or continued strength? And how do you see new immigration policies impacting the labor market?
Okay, to the first one, some of both. It's remained strong. I told you, that's stable, full employment. That's what it looks like to me. And partly from immigration, partly from the way we measure some things, just the big two, the unemployment rate and the number of jobs created in the month, those are usually what everyone looks at. They've gotten a little noisier over time. So now we're looking at some broader measures, expanding the aperture of sniffing. That is a mixed metaphor, but more not. We're sniffing more area to include vacancies data, hiring rates, quit rates, a series of things. All the measures of the job market, to me, point very much to stable, full employment. At the same time, that is cooled from where it was. We were hotter than stable, full employment there for a while, where you couldn't get workers. And especially in places, the unemployment rate in parts of Iowa was in the twos. And when we would go around, we would go to factories, we would go to bank, the guy at the bank said they couldn't hire any tellers. They had midweek quits that people would be like, hey, I just heard I can get $40 an hour over there with no, I'm done. You can find somebody else to come in Thursday and Friday. Okay, that was a non-sustainable kind of environment. So it has cooled, but it cooled to stable. Immigration, I don't know. I don't know what the impact is. It depends what happens and how many people are affected. New immigration has been more than 50% of the labor force growth in the United States over some medium to longer run period. So it could affect the labor force. And last night we heard some of that discussion from CEOs that labor force participation here in Eastern Iowa has been high, really high. So there's not an untapped group that it's going to be easy to turn to if we go back into a period of labor shortage. So the stable full employment is still probably about as good as what we're hoping for.
All right, let's talk about housing and it's important to the economy, especially in light of the national median price of a home being $431,000 compared to just $258,000 in 2019 for a gain of 67%.
You just be a little careful with median house prices because it's not the same house. If it was 67% housing inflation for the same house, we'd be in even more of a worked up panic about housing costs than we are. Housing's critically important to both consumer spending, how well people feel like they're doing, as well as construction being one of the more cyclical and interest rate sensitive parts of the economy. Widespread feeling in surveys and the data that the price of housing is out of control. And if you broke out the components of inflation, it's been the most persistent and puzzlingly persistent part of inflation. That goods inflation back down to where it was pre-pandemic. Services inflation still a bit higher than it was, but down some amount. And only recently has housing inflation come down. That thing has just been way higher than it was pre-pandemic. And so maybe you'd call it a thought experiment. Think about the price of goods at Target or Walmart or Costco or something compared to the price of housing. It's been a very substantial difference. In the extreme, about as big as has ever been a difference in the last several years. Goods prices minus 1% inflation. Housing inflation 6-7%. But the important thing to remember is that's not new. That's not discovered. We didn't just discover that relative price shifting away from or toward housing. That's been going for 15 or 20 years. Pre-pandemic, overall inflation was 2%, but that mass housing was like 4%, goods were minus 1%. If you compound something 5% a year for 15 or 20 years, at the end of that time, they're pretty different in price. So young people today who are saying, you know, my dad had one job and was able to buy a nice house, and now I can barely afford to pay rent on a rental apartment, they're not wrong. The relative price of housing has shifted. I think some of that has to do with building regulations and the supply costs of building housing, but also part of it is a puzzle. And the relative price of housing is one of the biggest pinch points facing a consumer.
Let's talk a little bit about the dollar. What are your thoughts on the dollar dominance and the role of the Fed as the guarantor of last result going forward?
Okay, the dollar policy set by the Treasury. So the reserve banks, we don't weigh in on dollar policy. That's just in the background conditions for us. I still find the argument that the U.S. dollar is about to cease being the reserve currency of the world to be overstated. I think if there were serious doubts about the credit capacity of the U.S. government, the loan rates would not be 5%, which are just kind of standard historical rates in the U.S. But anytime you're announcing major tariff and trade policies that would affect the demand for goods or for dollars, like what we're going through in this period of uncertainty, it's not surprising to see fluctuations taking place in the value of the currency.
So what sectors are showing the most promise for innovation and growth? Are there particular industries the Fed is watching closely? And talk a little bit about AI and how has that changed your thinking with regards to productivity and jobs?
Okay, one of the brightest spots in the economy in the last 2 years has been a very robust growth rate of productivity. Output divided by the output per worker or output per hour of work has been growing 2% instead of 1.2%, which it was before COVID, which seems like not a lot, but if sustained, is hugely impactful. There's an economist described, the difference between a productivity growth rate of 1% and 2% is 100%. And there is an element of truth to that. The productivity growth rate is what our wages are. How fast can our wages grow without generating inflation is determined by that productivity growth rate. I and most economists were kind of skeptical that it actually could be AI causing this increase in the growth rate because AI just not big enough yet to do that. That said, if you look at the sectors where productivity growth has risen the most from pre-COVID to now, our research at Chicago Fed is finding that it is concentrated in a lot of tech-adjacent industries. That suggest it might not be a one-off. We might be able to ride a new technology wave for a few years. And if we did, yes, there are job implications we got to think through. At the end of the day, though, remember, productivity growth what made us rich. So if we could increase the productivity growth rate and sustain it, eventually these higher tech sectors, it's going to bleed over into service sectors and others that are users of the technology, and our incomes will be higher than they ever were before. She was coming with questions. I thought she was coming to say, "Shut him up, get him off the stage."
So, what keeps you up at night being president of the Chicago Fed?
I usually say that the central banker's job is not to sleep at night. You know, we're the night's watch. We're supposed to. There shouldn't be anything bad that happens that we haven't at least thought of it and thought through how should we respond to that. I think that the perennial, it's always back to the dual mandate for me. Anything that's going to lead to rapid spiraling away from where we want to be on inflation or unemployment are the kinds of things that keep me up at night. And I do think an escalating, unbounded trade war between all the major economies of the world would have a chance to really spiral up the inflation rate. That makes me nervous. If geopolitics gave us big supply shocks that are stagflationary in direction, that would kind of keep me up at night because, like I say, there's not an easy solutions manual for what the central bank should do to respond to those. And then the Fed itself was created in the wake of financial crises, the panic of 1907. Anything that destabilized the financial stability of the United States, those kind of be my three. I'm not going to give you four horsemen. Those would be three. That'd be plenty of horrible.
Okay, we just got a couple minutes left. I got two questions left. Talk a little bit about your concern about cyber attacks for the Fed and all the money that the Fed moves around.
Look, the Fed runs a major component of the payment system of the United States. So wire transfers, the majority are coming over the Fed rails. ACH, like direct deposit, we're doing a lot of those transactions. $5 trillion a day of transactions we're doing. We take the threat. In my view, that payment security is the same thing as national security. People know the water supply, the electricity supply, those are national security. The payment system is in there. So cybersecurity is absolutely fundamental and vital.
So last question, what challenges and opportunities do you see for mid-market companies in the region, and how can they best position themselves for success?
Mid-market companies, there's a lot of diversity of the industrial base in Cedar Rapids and a spread across the nation. There's no generic answer to that. It depends what industry you're in, and it depends how mid is your mid-market. That said, mid-market companies are oftentimes some of the most sensitive to credit conditions, oftentimes not accessing public markets yet, so they're more bank credit focused. The interest rate environment is going to make a big difference. I already told you what the interest rate environment will be in the near to medium term is going to depend on how long policy uncertainty remains. But if we're getting some resolution on policy uncertainty, I think we could have an easing of credit conditions, as I described. And then if you are in manufacturing or agriculture, it does seem like it's going to be a bumpy year. That it was already getting to be a bumpy-ish period before there were the policy uncertainties coming in April, because of farm incomes getting squeezed, the margins getting squeezed in the sense of costs rising, the sales prices sort of capped. And in the manufacturing sector, we had this weird environment where the consumer budget shifted heavily to physical goods because they could not spend money on services. And now it's shifting back to services. So there's a little bit of a unwind. The smaller microcosm, the Peloton problem, that everybody's going to buy a Peloton. Peloton's going to build a bunch of Peloton building factories. And now they're like, does anybody want a Peloton? So we're working through some of those. Depending what industry you're on, it could be bumpy, but I still think fundamentally there's a stable full employment with costs under control back to steady inflation you don't have to think about story that would be a pretty positive story for the macroeconomy.
Please help me give Austan a round of applause.